What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be doing some stock analysis for Shopify stock. Today, the stock is down 5%. In the last year, it's up 69%. And in the last 5 years, this stock has gone on crazy runs and crazy falls. I remember back in 2019, 2020, I invested into the stock at about $30. It ran all the way up to 169. Then the next year, it fell down to 27, and now we recovered up to $108. So it's really been a roller coaster of a stock. But if we look at the revenue chart, we can see that in the last 5 to 10 years, this company has been pretty consistent with growing their revenue. They've averaged anywhere from 45 to 64% revenue growth per year in the last 5 to 10 years. So there's no denying that has been a phenomenal growth stock, and their revenue looks great. As for the net income, not so much. They've obviously have barely been able to make a profit for, even, let's see, 2020, there was a small profit. Next year, they did 2.9 billion in income. And then last year, they did 132 million in income. Let's see for trailing 12 months what their income is looking like. So last 12 months, they're up to 1.2 billion in income. That's pretty good. And the other thing I would like to point out here is Yahoo has their forward PE as a at 86 times, right? Now, I remember back in the day, this stock traded at 1,200 times earnings. I'll never forget that because it was one of the craziest valuations at the time. But in the last couple of years, you could see that it's traded down even to 66 times forward earnings, which is insane. I mean, I guess if the company was growing 50, 60%, it makes sense. But as you're going to see here, the revenue growth is only 24% this year and then 21% next year. So if you're talking 70, 80 times, Ford PE, that seems like a lot. And this company, it kind of reminds me of Tesla, where it's like the growth isn't really not that crazy, but the valuation is crazy. So we're looking at a $108 stock. Let's do the math here. $108 stock, and this year's earnings is expected to be 1.3. That's 83 times this year's earnings. Okay, that's a lot. 108 times next year's earnings, 73 times. You're paying 73 times for 2025's numbers. Okay, that's insane. That number should be like 40 or something. That should be 35, 45, something like that. So this is pretty much trading at double what it should be trading at, really. And that's where I'm kind of like, I don't fully understand. Like, are they thinking, I mean, if growth is expected to slow down, I mean, they pretty much doubled I guess they almost doubled their EPS from last year going into this year. Their EPS is almost a double. So I guess that's good. Maybe I guess their margins are, we can look at their margins, but maybe their margins are getting better. The cash and the debt ratio looks good, so no problem there. Let's see. Maybe I mean, I don't know. The revenue growth is definitely not anything insane. The profit margins, I mean, remember, they were negative most of the time, and then there's only been a couple quarters when they were profitable. Okay, so 41%, 30%, those are strong margins. But last quarter, 8% profit margin, that's not good. So I'm not really sure what. Luckily, the shares outstanding is not jumping up like anything crazy. Most of the time, that's what you see with companies that are losing money. Free cash flow is going up though, so that's good. That's a good thing. But I mean, the valuation is just insane. We're talking 20%, 20 what, 24% growth into 21% growth expected, and an EPS of, that's what is that? That's probably 15% or something. That's not a lot there. So I don't know. I don't see how this makes any sense. Now, we can't look at PE ratio history because they weren't profitable. So we have to look at price to sales. And as you can see, well, first of all, 18 times price to sales is just insane. And it's been running up now since what, over 2 years now. It came from a price to sales of 6. Now we're up to 18. So that is just insane. Like, again, if this company was putting up 50%, 60% growth numbers, that'd be different, but they're not doing that anymore. So the PE on this stock should be like 35 or 40. And really, what's probably happening here is just that our market is pretty inflated right now, and it's just the S&P as a whole is just really richly valued. And so a lot of these stocks, like how I said, this and like Tesla, these companies are going to have to come down in premiums. You cannot sustainably trade at a PE ratio of 85 times forward earnings. That's just insane. That doesn't happen. That only happens for a very short period of time, and then things fall. And really, 2024 has at this point it's looking more and more like 2021. We're not quite there yet as where we were by the end of 2021, but we're more than halfway there. If this market rally goes on for, let's say, just a couple more months, 2 or 3 more months, we're going to be in the exact same position we were in 2021. And then look what happened that year. It doesn't mean our drop's going to be this big, but it'll be close. It'll be maybe 70% of that, and it's going to be bad if the market rallies another 3 months. That's why I'm hoping we get a nice 15% correction or so in the market by the end of this year, and we see some of these stocks go back to healthier valuations. So, okay, so let's put it this way. The revenue growth for this stock is great. Oh, and the other thing I forgot to bring up, the balance sheet. Balance sheet is also solid, okay? Equity is growing, how I said. The cash to debt ratio is perfectly fine. We have equity of just a couple years ago is 6.4 billion. Now we're up to 9.1 billion. Okay, not horrible. 9.1 billion for a $141 billion company. And really, the ratio of assets to liabilities is phenomenal, right? 11 to 2, that's phenomenal. So no complaints there. Balance sheet is strong. My complaints would come with, well, first let me say revenue growth is strong, right? Strong. It's slowing, but it's strong. It's been consistent. There should be no problems with Shopify growing revenue in the next 5 years, really. The next 5 years should be solid. Even if that means 15%, 20%, as long as it's consistent, that's fine. Okay, we should expect that growth to come down to 15, 20% because obviously first of all, it's almost impossible to grow 50% per year for, 2 decades. That's almost impossible. But Shopify is already showing that those numbers are slowing down. But here's where the problem is. For a company that is doing, how much are they doing in revenue? 7 billion. And well, actually, it's going to be more than that. What are they doing for 2024? Let's see. The last 12 months, over $7.7 billion. $7.7 billion. Luckily, we do have a strong margin, 1.2 billion on the bottom line coming from 7.7. That's strong. So no complaints there. But what happened the last couple years? Why were they doing $6-7 billion and losing 2 to 3 billion dollars like that? What was going on there? So that makes me think, that margin is not strong. And even if that margin, like, okay, let's see, do we have any? Yeah, I mean, these are low. Okay, so like that, let's say that's that quarter right there, 41% profit margin. That only happened one time, and we have it back here. But again, these are like exceptions. The consistent trend here has been them losing money, and they're lucky to even make a 8% profit here. So that's just something I don't ever like to see. When the company does billions of dollars and I think Shopify is probably number 3 in e-commerce. I want to say it's like Amazon, Walmart, Shopify. That's what it was a couple years ago when I used to look at this stock. But it's from what their investor presentation said, they are growing market share, which that's fine. I believe that. But when you're at this scale, I mean, it's not like Shopify is a new company. They were founded 20 years ago. So when you're at this scale and you're approaching $8 billion a year in revenue, why are you struggling to make a profit? That's where my issue is. So, you could say with economies of scale and maturity that the profit margin is going to strengthen and the consistency is going to show up then. But I don't know. That's I don't know yet. I feel like it's a 50-50 right now because what's been going on the last couple of years? Why are they, this could happen next quarter where they lose $2 billion or something. That like we're not. I like to see consistency and a nice track record of them putting up good numbers. So I don't see that with this stock. And not to mention, even if they were consistently making a profit, the valuation is insane right now. 86 times forward earnings, and we're talking 18 times price to sales. That's insane. Okay, that's insane. So maybe if the stock was trading at 60, 50 times earnings, might make a little bit more sense. But right now, I have to say this stock is overvalued and it needs to come down, and it will come down sometime in the next couple months. I think this stock will come down probably below $90. And then when that happens, then we can look further into it and see if it's a good buy. But thank you for watching. I will see you in the next video.